All right, now we want to take a look at what are called long-short funds, also risk management. We've got Kathy Boyle of Chapin Hill Advisors joining us. Robert Kaimowitz, he is the Chief Executive Officer of Bullpath Capital Management and also portfolio manager of the company's long-short mutual fund. Rob, good to have you with us. Thanks for coming in.
Pimm, thanks for having me back.
This whole idea, Kathy, also about risk management, I wanted to bring that up because the issue is making selections when it comes to people's investments, right? And Rob, you were making the point in some research that maybe looking at past performance is not the best way to make any kind of selection when it comes out to your portfolio, right?
It's almost like driving the car only looking in the rearview mirror. If you don't have a view on how you want to structure your overall portfolio, then you just can't pick the hot mutual fund or stock of the past 6 months without looking at how you want to position yourself for the next 5 years. You know, I think in 3 to 5 year clips rather than how we did in the past 6 or 9 months.
So when people look at, let's say, the performance of a specific mutual fund, you're saying that if it's gone up tremendously, I mean, if it's really outperformed the market, would you say that there is enough risk management control in there?
Well, I think Rob's point is in a year like this, where the market has had a lot of turbulence and has shot up, if the fund is up as much or more than the market, then obviously it's 100% equity or it's in the hot sectors. People unfortunately chase the hot dot. And that is the problem. Well,
what happens is money flows into those funds precisely at the wrong time, right? So I would imagine a lot of funds had a great 2007. People piled in. They have no risk management. In other words, they're 100% long the market. You know, I saw a fund that was heavily touted in this week's Barron's. I'm not going to mention the name of the fund. They're up 60% or something this year. So I decided to look at it. I know the company quite well. And from peak to trough, they were down 65% last year. In 2000 and in 2002, they underperformed the market by 20, 30 percentage points. So just to tout the last 6 or 9 months makes no sense unless you look at it in a framework of your overall portfolio.
So that means you've really got to know what the risks are, right? I mean, the idea being that maybe these are the right funds for a certain type of investor, an institutional investor, and understands this, but understand that it could actually go the other way.
Oh, absolutely, big time. And I think what you have to do is pretend you had $10,000 or $100,000 or whatever the amount of money is you're thinking of putting in this fund. Go back, and as Rob says, don't just do 6 or 9 months. Go back to a 10-year track record, go back to a 5-year track record, and see what it would have been at the worst. Because when I do that with people and I say, are you willing to stay in this portfolio if this happens again? A lot of times the answer is like, no way.
What about this, Rob, what about this whole idea of, you know, deciding on certain types of investments, talking to money managers, professionals? Should people always ask, you know, what was your worst investment? Because there's bound to be some clunkers, right?
I think asking what your worst investment is a great idea. I have a funny story. I was talking to a broker friend of mine just last summer when we were converting our hedge fund into a mutual fund. And I said, well, how do you pick mutual funds? He said, well, we look at what's hot. Oh, really? So do you use any long short? Do you use any risk management? No. We don't even really know what that is. I said, so how'd you do last year? Oh, we got creamed. I said, okay, so you're driving down the road using only the rear view mirror to make your decisions on where you're going to. You're driving at 100 miles an hour because you're completely 100% long, and you're doing it without wearing a seatbelt because you don't have any risk management. So why do you think you got creamed?
And what was I mean, did they recognize that there was a big change that needed to be made, or no?
I think that it's a gradual thing that's going on. I think that there's some very sophisticated RIAs are looking at how to employ both tactical allocation and the endowment model.
RIAs, for everybody that understands, go to RIAs.
Registered Investment Advisors, or wealth management professionals that design portfolios for you that will work for you over a long period of time. And, you know, a lot of them have recognized that you can improve performance in your overall portfolio over time by reducing risk, not by having the pedal to the metal all the time.
And Kathy, part of that reduction in risk scenario has to do with being able to go short as well as go long, right?
It does, and that's hard to convince the average individual because technically if you short a stock, you have unlimited risk. That's where these inverse ETFs have come in, but now many people misuse those and have held them too long and don't understand the risk, and the leverage ones have very poor correlation over a longer period of time. So for the average individual investor, unless they can buy a fund like Rob's, it's very difficult to find some way to hedge their portfolio.
And do you think, though, that you've got got to have some shorts in a portfolio as well as longs on a general basis?
I personally do. Either that, or if you don't have the risk tolerance and you have to have a heavy bond allocation, you have to stay short because we're worried about inflation risk. We're worried about longer-term rates. So a long-short fund or an inverse ETF portion of your portfolio to hedge some of that risk. If we're right and we're in a long-term secular bear market, we're going to look at some more steep declines.
Rob, what about this idea of sort of using long shorts in order to kind of create some balance in the portfolio? Does this resonate?
I think that's exactly correct. I mean, you need what we're seeing in terms of the new, very sophisticated models that are being used out there is that of the equity bucket in somebody's portfolio, they're allocating 20 to 30% of that bucket into long short. And what that does is it moves the risk-reward scale to a point where you get terrific equity returns with much less risk. So if you look at a fund like ours, we've meet or significantly beat the market in every calendar year since we've been in existence, but with on average one-third the market risk. Put that into your portfolio, it's almost like a no-brainer.
Then Kathy, why do you get sort of this drumbeat for people to just go into index funds?
Because funds like Rob's have traditionally been the province of very wealthy. They've been hedge funds. There's been a lot of challenge to make them a portable mutual fund and fit into the 1940s Act. There's lack of restrictions on leverage.
But you do that at Chapin Hill. You're long and short.
Well, we are, but
investors.
we're a little bit unusual.
Okay.
I think the average advisor out there belongs in long term. Hang on.
Well, we no longer have any more time. I want to thank you very much, Kathy Boyle, coming in from Chapin Hill Advisors, Rob Kaimowitz from Bullpath Capital. Stick